Hey, what's happening everybody? Welcome back yet to a brand new video. This is Tarafdar, your guide and mentor, and today we're going to talk about starting from scratch when it comes to building and establishing your personal credit. What are some of the specific things that you absolutely need to do before you start to begin on stacking up credit cards? What are some of the exact mechanisms in reference to building out a very solid credit profile, and exactly what does that comprise of? And the purpose for today's video is to give you guys context, because a lot of individuals in the past have asked me consecutively on, hey, what are some of the first credit cards should I get? What are exactly some of the things that I need to do in order to have a nice credit score? How long will it take for me to build my credit? What can I expect to get by the end of my journey when it comes to establishing that credit? And of course, notwithstanding, what are some of the typical credit scores will I need to have in order for me to go to banks or credit card companies and so on and so forth in order to get approved for, let's say, the maximum limit. So there's a series of different things that we really need to cover in today's topic. And let's start you off by understanding the basis of exactly why credit is critical to everyday living, specifically now with the COVID standards and how things have been going, and how the landscape of credit is going to change automatically. There's a whole lot of things that are happening in the credit space that you absolutely need to be extremely aware of, but not only aware of, but understand the strategies and the tips and structures that you'll need to deploy in order to be effective when it comes to building your credit, especially when it comes to establishing bankable relationships and long-term credit. And how that would be the platform is going to navigate, and how it's going to shift, and the momentum, and how it's going to take a completely different direction, and why you need to adapt to those sets of directions if you're going to be partaking in the specifics of establishing long-term credit. So let's start you off. What's the baseline thing that we need to understand when it comes to personal credit? What exactly is the first step to establish long-term, critical, and strategic credit? The first step, and is always going to be, is do you have secured or at least a revolving account with an existing creditor that you have full responsibility with? And the reason I say that is because that is the baseline. See, a lot of people who are trying to build credit, especially those who are seeking credit, already are at a financial disadvantage, unless otherwise the specific goal of that credit is to get approved for a home. And that simply means that you want to leverage funding, get a mortgage, which is a secured asset, and be able to pay that mortgage down and get into a home. There's a high level of confidence there that you have the financial capability to hopefully afford a mortgage, and therefore you're not strapped financially in order to qualify, because you'll have a down payment hopefully, and then you'll step into the territory of underwriting for a mortgage. But let's assume that you're not in that situation, and you guys are just starting off, and you don't have the financial means or capabilities or capacity to withstand that kind of debt obligation. So those who are starting off on their credit journey, those who are seeking funding, those who are thinking of obtaining credit, are typically at a disadvantage from the get-go. And the reason I say that is because I'm not saying that they're in a disadvantage because they're not good. I'm saying that they're at a disadvantage because there's a couple of things we need to consider. Number one, they don't have the financial means and capability to have large amount of deposits with banks to harvest that relationship, grow it, season it, mature it. And that requires an extensive amount of deposit. That means like you're going to start with like a $1,500 to $3,000 to $5,500 to even $7,000. And the larger obviously the better, because that means that you can spread your money across multiple institutions. That's typically the goal. But let's assume that you don't have that kind of money, right? What you'll need to do right now is you got to find a way, number one, to wait a little bit until your debt obligations that you currently have are being paid down. If you're looking to establish credit, you need to start maintaining records. You need to start making on-time payments. You need to make sure your creditors that you're obliged to currently are respected in a capacity that you're paying on time. That's not actually a flawed situation where you're missing payments and all these type of things. Because if it is, then you're definitely not doing the best you can in order to start solidifying your existing relationships. Once you've established that certain parameter, that you're paying your bills on time, that you're paying down your creditors and so on and so forth, try to upscale your payment methods. And what I mean by that is, like, you guys are paying your minimum payments, and you can slide by it and you can let it go, and that's still satisfactory. That's on-time payment, right? But what if you were to take excess and after making your monthly minimum payment, aggressively pay a little bit more towards the same balances that you're putting down via minimum payment? Not only will it accelerate your pay down and the time frame in when your credit cards are going to be completely, with no balance and so on and so forth, but you're also helping establish some credit muscle there. So let's assume you're paying $50 a month in minimum payments on one of the cards, and let's say the balance is $1,000. If you can afford to add another $50 after your minimum payment, a few days after that is, typically 3 or 5 days after, what ends up happening is that's actually going directly towards the balance, and no interest is being absorbed. And that means that, the bill coming next is going to be less. And that means the minimum payment, you can still continue making that $50. But then in addition to that, let's say another 5 days from there, you can make another $50. So think about the double payment methodology. And the reason I say this is extremely critical is you're doing a couple things here, right? Number one, you're going to your goal in order to reduce your balances faster, which is immediate. But number two, you're actually helping exercise your financial credit muscles and the payment history muscles. FICO 10 data trends, the FICO 10T, which is the trended data in the 24-month payment history. If your creditors are logging these financial activities that you're paying more aggressively and you're doing so on time and you're being very, acute with the process, what's happening is that's going to be warehoused. So in the future, if you were to go for unsecured funding, the likelihood of you getting more is increased, right? Whereas if you were just to maintain your minimum payments and you're not necessarily going towards the goal of a lower balance, because that would be required if you were looking to get more funding, right? But if that's not the case and you're just paying your minimum payments, you're not going to get favorably underwritten. You're probably not going to get money in the first place, right? So those are a couple of things and data sets that you guys need to start to consider, right? These are some of the things that you guys need to move towards, you need to gear towards, because that's the mechanism that needs to be deployed, which is the very first baseline step. Obviously, like I said, this is considering that you're at a financial disadvantage. You might not have the liquidity that's required to go out there and start depositing to multiple institutions and building secured cards and getting revolving accounts. And on top of that, working those financial muscles too, right? It's not just a perspective of getting those accounts, but now you have to borrow on them, and then you have to pay, and you have to borrow, and you have to pay. That requires an excess amount of deposits, excess amount of financial transactions, albeit the money can be spent in needy things, not necessarily unnecessary stuff. But regardless of the situation, these things have to be exercised. You have to do these things. So if you're at a financial disadvantage, and you're in a situation where you can't necessarily have, or you don't have the luxury of a lot of money or liquidity, then these are the baseline things you can absolutely do right off the get-go. And I strongly encourage you guys to do that, because this is going to help you get to a point where now your creditors, like I said, are warehousing your financial performance and your data. And that FICO 10T, which is just trended data on a 24-month cycle, is helping you establish a certain underwriting parameter to get a lot more funding down the road. This is the critical component. So that's the first step. Now, I know it's been 7 minutes in where we're discussing the first step only, but I tell you what, this is probably one of the biggest steps you need to take if you don't have the financial means. But let's assume step number 2, you did have the financial means. You're just not spending it, and you're just being very cautious in the next few steps on how you go about spending that money. Number 2 can simply be where you take the money. Let's start with $5,000 or perhaps $4,500. Let's say you had $4,500. You take $1,500, split it by 3, go to 3 different prime institutions, and open secured credit cards. Once you have established those secured credit cards and they're open and they're good, and hopefully, the goal here is, look, I don't want my credit to be hit. You can do a soft pull, but if I get a hard inquiry on this, it's going to affect me, right? So negotiate that, and you have the ability to do so. And most times when you're dealing with a credit card company, or perhaps a major financial institution that has products outside of just credit cards, because they're servicing clients on a regular basis, and that's what you want to aim for. You want to go with branded institutions that have high credibility, high financial institutional products, high diversity of financial products as well, because they have the capability to make that decision. Negotiate with them and try not to get a hard inquiry. Let's say out of the 3 you have 1 hard inquiry, that's fine. But the goal is spread your $4,500 across 3 institutions, being $1,500 each. Once you have established that and that account is open, now what you can simply do is you can start to pay or borrow, let's say up to 30 to 40% of that account, or even 45. And within the next 60 days, and that's the tactic you want to deploy, within the next 60 days, try to pay that down while maintaining a small balance, which is equivalent, if not a slightly greater amount than the minimum payment. And the reason why I say that is because that really is demonstrating the financial muscles, right? That really demonstrates with all those creditors that you're doing everything in your power to be able to borrow on time. You're a good customer, stuff like that. But keep in mind, the amount you're borrowing, however you're swiping those cards, and the transactions that you're inheriting for that, in order to work those financial muscles, make sure that they benefit you, that there is a dividend behind it, right? A good example of this is you can swap your bills, right? You can put it on those credit cards temporarily, and you can change it in 60 days after you pay that down, and just rotate and recycle and rotate and recycle. Let's say you don't have the financial means to borrow up to 30 to 40% on all of them. What you can simply do is start with 1, borrow a little bit on the other 2, because you don't want them to close your accounts due to inactivity. But what you want to do is you want to borrow maximum on 1, Once you pay that down, after 60 days, recycle to the next, and so on and so forth. And then you have about 6 months of financial activity spread across all three, depending on the affordability and how your financial circumstances are. This is the second step, if you have the money, right? It's to get to that point where you can securely obtain financial, the merit of the underlying credit or revolving account from those institutions where they can give you the money. And understanding how to work that credit muscle, that's the second step. Step number 3 is really based on your negative items, right? If you haven't done these first 2 steps, if you haven't paid down your credit cards, if you're not obliging on time, paying more than your minimum payment and creating a dedicated timeline of a structured and stronger financial payment history, then you're not necessarily looking for credit repair. You're looking for an escape mechanism. Credit repair and enhancement is based on increasing your score that's going to last, not something that's going to disappear overnight with these non-essential primaries and so on and so forth, things that I've been trying to give you guys direction on for the longest time, but I think you're starting to see it because the markets are dictating in my feedback. What I think is important right now is just to focus on these elements and these components, right? Step number 1, pay more than your minimum payment. Pay twice the minimum payment, but pay it in a very strategic way. Respect your minimum. A few days later, pay the second part. And once you do that, like I said, your balances are coming down. Your utilization increases, your payment history gets enhanced. That's amazing. If you have the financial means, step number 2 is just go out there and essentially deposit money into institutions that are very, very high level. And from that perspective, start to borrow up to 30 to 45%, pay that down in 60 days. If you don't have the means to spread it across all 3, or let's say multiple, focus on one account first while borrowing a little bit of balances on the other, because again, you don't want them to be shut down due to inactivity, which is a big concern. From that angle, then you guys can move on to bigger and better things, okay? And number 3, like I said, you just focus on removing the negative items very strategically, but understand how to do that. And to do that the best way possible, I strongly encourage you guys to check out the course in the description, The Ultimate Personal Credit Mastery. This is the stuff I teach at the highest order. You guys will absolutely benefit from the course, so I encourage you to do that so you can take advantage of the mechanism of how to remove negative items and do so in a very compliant, strategic, and strong way. And with that said, I hope you guys enjoyed today's video. If you haven't subscribed yet and you've been following me for some time, I strongly encourage you guys to subscribe, turn the notifications on to all, smash that thumbs up button if you enjoyed today's content. Let's have a discussion, and if you have any specific questions around the 3 mechanisms of what we discussed today, if you were to start from scratch on establishing your credit, leave it in the comments section. Let's have a dialogue. And with that said, this is definitely your guide and mentor, Ali Tarafdar. I'll catch you guys in the next video. Bye for now.